Hello, and welcome to another episode of the Power Law Investor. Today is the 21st of August, 2025, a Thursday. And as I'm making this video, Bitcoin's at 113.5K, a little bit of a decline from recent prices, and Caspa's at 8.5 cents. And today, I want to really get into understanding how we can make the better decisions on figuring out when to buy assets that we're interested in, particularly using the example of Caspa. So, as you know, I've been developing the PAI or Power Amplitude Index. This is looking at the price trace of Caspa, and the PAI index goes, or the PAI goes all the way from 0 to 1. The closer it is to 0, the better it is as a buying opportunity. The closer it is to 1, the more cautious we should be. It could be in an overbought kind of situation. And so the question is, and it is important to realize that these are the values that we would see if we were back in time at this point. So if you went back in a time machine and you went to this time over here, November 8th, you would see exactly this value over here for the PAI. And the question becomes, given this PAI, how much does it improve our ability to buy Caspa, and how much does it improve our performance if we use this instead of just buying it every day, for example, or trying to find a particular point when you think the price is good? So how can we identify what a good price is, and what would the results have been for Caspa over the last year or so? And I used the beginning of about June 2024 because that was about the time that I started getting interested into Caspa, right? And so if you look at the Caspa price now over the last year, you can see, okay, well, I would want to buy at these dips, right? But there's nothing that could have told us, hey, this was going to be a dip coming over here, or that we'd have this sort of section over here, then the price would go up and the price would go down. Looking back, of course, it becomes easy to see those things. But in the moment, how do we know what makes a good buying decision or not? And the idea is that the PAI, through this color index, indicates when it is a relatively good time to buy. So based upon this, I did some calculations and sort of back tested what this algorithm would have produced and how much of an impact that would have had. So the idea is not to be DCAing in every day, but to be selective in our DCA, right? And that's the concept over here. So we don't DCA across all this time, which we could if we believed in Caspa as something that is going to produce value in the future, or the price is going to go up. But we say, okay, I want to be selective and I want to buy when the price is low. But of course, when the price is low, emotions are oriented towards fear, and it's difficult to pull the trigger because people are thinking, including us, very naturally that, oh, the price could go lower. When the price starts rising, on the other hand, then we don't know whether the price will continue to rise or not. So the greed element kicks in and says, I better jump in to this as soon as possible, right? And so using the Caspa, if we had used the PAI for Caspa versus regular DCAing average over here, the average price in the DCA would have been just over 11 cents. But if you used the PAI, you with a value of 0.2 and saying, okay, whatever it is below 0.2, I'm going to go ahead and buy, we would find that our average price had actually dropped to below 10 cents, so an improvement of 11%, right? Now you may want to say, so let's take a look at that to make sure that we understand exactly what I'm saying. I'm saying that if it is at 0.2 or below, so that would be here and here, I've sort of toggle those off. Those are the spots I would be buying in this region, and I would be buying in this region within this gray area, right? So what happens, let me just turn off all these other ones so we could see, what happens to my price if I decide to buy only in these particular price points, right? That is the question that we're answering. And if we do that, we get to see that we are tracking the bottoms quite well. This is again the same thing. These are all the points where the buy signal is triggered, because we're looking at a 0.2, not 0.2 on the price, but 0.2 on the PAI, right? Just to be clear, again, this is here, sorry, here's where we are. This is the 0.1 to 0.2, and this is the 0 to 0.1 PAI category. So this is where all the buy signals are triggered. And if we look at this, we find that compared to just DCAing on a daily basis, our average price is considerably lower because we're buying only when the PAI is below 0.2, right? So you can see immediately from this graph that the average purchase price is much lower than the DCA price if you were just blindly DCAing in every day, right? And that really is showing where the power of this is coming through, is that if we look at the strategy comparison metric over here, you can see that with the threshold of below 0.2, you're buying 40% of the time, right? So you have 447 days from the beginning of June to right now, so a little over a year and a few months, right? But we're buying only on 156 days, but the buy frequency is around 35%, right? And so that means we're only buying on 35% of the days that we think that the price is the lowest. And again, for this, we're putting in $100 a day, so 156 days at $100 means 15,600 invested. And if you look at it, it is much stronger than buying on the DCA every day, right? Because our average price has gone down. Now, the total amount that is invested, of course, is lower also because we're choosing $100 when the threshold is below 0.2. Now, the buy frequency here is 35%, right? Buy means that we have, of all the total number of days, we're only buying at 35% of days. So you might look back and say, okay, this is reasonable, right? That we're getting this, we're tracking this and we're buying only when the price is low. That's, you have about 10-12% advantage. But let's say you wanted to be even more selective. And you said, you know what, I'm not going to be buying only at 0.2. I'm going to wait for the really good opportunities at 0.1. Now, those opportunities are fewer, but they are even more powerful, right? And so if you switch to that, if you look at this, the parameter of 0.1, the conditional DCA average, or the average price, goes all the way to 8.5 cents, right? And that's almost a 25% improvement in the price that you would pay. Now, this can't predict the future, right? It can't say that the price for Caspa is going to be this in the future. So even if you look over here, even the conditional DCA return based on today's price, which is about 8.5 cents, we're still losing 13%. But compared to the DCA, which would be losing almost about 24%, right? So that's an improvement. But if we become even more selective and we go to a PAI of 0.1, you start having a positive return because your conditional price has become so much better. And this is why I want to emphasize to you guys why I think this is such a powerful methodology for investing, right? It doesn't give you the daily trades, but in real time, it is telling us that these are good values to buy in. And we don't know what's going to happen in the future, but using all the information that we have in the past and making buying decisions based on the PAI can significantly improve our average price that we're buying at, right? And in this case, it's 25%. Now, if we go back and look at that same analysis, we can see that we're only buying 12% of the time. What does that mean? That means 88% of the time you don't buy, and that is the hardest part to do because you're constantly going to be buffeted by these forces of fear and greed. Right? The greed makes us buy when we shouldn't be buying, and the fear makes us not buy when we should be buying, right? Or did I get that wrong way around? Either way, you guys get the idea, right? So using the PAI, we end up with a much smaller period of time. You're only buying 10% of the time. It's not this daily trading. It's not the back and forth, but you buy when it makes the most sense because we know historically, and that's how the PAI is generated. That's what the amazing part of it is that based on its history, we think this is going to be a great price with the PAI methodology. Is the PAI methodology perfect? No, I'm sure there could be better systems out there. I don't know, I haven't found any. But that's why I developed this, and specifically for Caspa, but although we can expand it to other assets also. Because the power law isn't necessarily working for Caspa once it stopped following that trend that we were looking at. So we needed another methodology to try and figure out when are going to be the good times to be buying Caspa or not. So based on this, you can see that we can drive the average price that we're paying down considerably, right? From all the way here while the regular DCA, which again, most people don't do that. Most people will just buy in a big chunk when they think the price is good or the price is shooting up. But if you adopt a methodical approach towards buying when the PAI is below a particular threshold value, 0.2, 0.1 in this case, 0.2 in this case, we end up with a much lower average price. Now, the part that I want to highlight is that with both of these strategies, the majority of the time you don't buy, right? We are buying very selectively, and we know and can place our bets with confidence because the PAI is guiding us. So for me, this is very exciting because it gives me a very quantitative validation of how I am going to be using the PAI framework going forward for my own personal investing, right? And of course, this is not financial advice, so I encourage you to think about your own situation, but it is correctly identifying a majority of the times when it is a good time to buy. Is it perfect? No. It's not perfect because it can't predict the future, and sometimes the signal is triggered and the price goes down lower, right? So for here in November, the price was around 11 cents and the PAI value was low, so we would have bought. But then, of course, the price went up, but then it did go down again, right? All the way to about 5.5, 6 cents. So the PAI can't predict the future because the PAI at November 7th is only looking back in its history at that point. But the more history we add onto it, the stronger it becomes and the more reliable the signal becomes. And by using the PAI at thresholds that we find effective, such as the 0.2 or the 0.1, right, we can find the appropriate prices that we want to jump into. So I hope this has been informative. I will be talking a lot more about this on my blog, so please sign up at thepowerlawinvestor.com for email updates. Email subscribers will get the earliest and most freshest and unique insights. And of course, please go ahead and like and subscribe this video and this channel too. So that's all for now. Hope you guys are having a good day, and I'll see you on the next one. Ciao.